Welcome to Illuminati Silver. We tell you the truth about silver. Today is Saturday, the 3rd of July 2021, and we're looking at a BBC article published a few days ago, showing the growth in online trading apps, helping the equity and crypto markets to attract funds which perhaps the gold and silver space could have benefited from. And we ask whether these apps and platforms are good or bad, healthy or dangerous, moving forward. And we've also listed below two videos that we've produced earlier today, our weekly roundup, and one asking, is inflation dead? And we've placed links to both of those below. So let's now take a look at what's exciting the youngsters in our society today in terms of equity trading. An article we were planning on publishing Thursday or Friday, but didn't do so because in the end we thought we'd leave it to the weekend, is this one that you see on screen now. It was published by the BBC 4 days ago under the headline of Why Small Investors Are Piling into Share Trading Apps. Often commented, and in fact set up a new channel dealing with alternative investment forms other than gold and silver, which includes cryptocurrencies, blockchain, smart contracts, and DeFi. And we are seeing that people, younger people in particular, are moving away from traditional methods of employing financial advisors and actually undertaking investment activity directly themselves. And this article really pinpoints the trend amongst younger people. And by younger people, we're not necessarily just talking about 20-year-olds. It's also now happening to 40-year-olds. God forbid that 40-year-olds are younger people. So let's run through the article and we'll pass some comments on it, because it's quite interesting to read. While small investors are piling into share trading apps. With time on her hands, 25-year-old Londoner Andrea Ion joined two stock trading websites at the start of the coronavirus pandemic. My boyfriend and I were caught in this really small London flat and just thinking we have to do something or we're going to go crazy here, she recalls. Over the last year, younger investors like Miss Ion have flooded online share trading platforms, including eToro, Freetrade and Robinhood. Well, we must be young because we've opened an eToro website or account. She and her boyfriend Jamie now post together on Instagram about their investing. We're witnessing an era where everyone can just start investing and accumulating wealth from their phones with nearly zero fees for a transaction, said Miss Ion, who lived in Romania until she was 18 and recently completed a master's course at Cambridge University, so clearly a highly educated individual. But is this wave of new investors a good thing? Adam Dodds, this is the picture of him, chief executive of Freetrade, argues that involvement in share trading is good for participants. I compare it to eating healthy or working out. It's a healthy habit, says Mr. Dodds. Well, it's certainly an extension of what Margaret Thatcher, Prime Minister of the UK back in the 80s, advocated. We were all to become shareholders. It's certainly been good for his business. Freetrade's registered customers grew sixfold in 2020, jumping from 50,000 in January to more than 300,000 in December, and up to 700,000 now. Nearly 60% of them describe themselves as first-time investors, and their average age is 31. Women now make up 1 in 4 of the platform's investors, up from 13% a year ago. And it's not just Freetrade. Other platforms have seen a surge in new customers. During 2020, Robinhood added 3 million users, a rise of 30%. And an eToro added another 5 million, a near 40% gain. One way trading apps have lowered barriers to getting involved in investing is by fractionalization, allowing users to buy fractions of whole shares. For example, a share in Elon Musk's Tesla was $880 in January. although it is currently around $688. For some investors, buying one share would use up all the funds they have available for investing. So buying a fraction of a high-value share allows small investors to make other investments and spread their risk. But this rush to invest has some people worried. Konstantin Gurdgieff, an economics professor at Trinity College in Dublin, points out that online discussion forums and social media can put all sorts of pressure on inexperienced investors. They might be more easily persuaded to join a herd of investors and pile into one overvalued share, for instance. Or the perception of lower costs might encourage them to trade more than necessary. Risk management and analysis falter, and fear of missing out, FOMO in other words, takes over, says Professor Gurdgieff. Research shows that enhanced access to trading and the perception of lower cost that these platforms offer leads to excessive risk-taking and overtrading by retail investors, he argues. Now, we would agree with that. We have witnessed no end of individuals now new to the markets, starting to trade every day and fascinated by price movements, which could be relatively small, and then forcing them to either buy or sell, depending on how those activities and prices move. Certainly the fear of missing out and the concept of greed plays its part, but then it always did in share trading to some degree, except for those investing for the very long term. Now we're going to agree with this next bit. For some, trading can even become addictive, he says. In this new era of trading, the so-called meme stock or Reddit stock has also emerged. This is a stock which has become a focus of intense attention on social media. The video game retailer Gamestop, which we produced a video of, or in fact 2 or 3, is perhaps the best known recent example. In January, its share price soared from $17.25 to $483 after contributors to a Reddit forum called Wall Street Bets encouraged investors to buy. Meme stocks, I think we'll see it again to be honest, says Lewis Harding, a 23-year-old in Leeds who blogs about his investing. He thinks investors should have to go through some free training after they sign up to a trading platform before they can start trading. The previous wave of so-called retail investors emerged in the 1990s, initially in the US. Online internet brokers like E-Trade and Ameritrade appeared on services like CompuServe and America Online. Their commissions of around $5 to $7 a trade were significantly lower than the established stockbrokers at the time, opening the market up for smaller investors. Many of the current batch of online trading apps have now pushed these trading commissions all the way down to zero, opening the floodgates to new investors who don't have deep pockets. But the way the trading apps make a profit has critics. For many of those apps, it involves something called payment for order flow. Now, this is important. US-based Robinhood, perhaps the best known of the new trading platforms, and others sell their orders to bigger firms called market makers, which pay up to a penny per share to execute them. While this process allows the apps to offer their customers free trading, it means the more their clients trade, the more the money trading platforms earn from the market makers. So, there is a strong incentive to get their investors to trade more actively, which is not necessarily in their best interests. Ask Warren Buffett. In some countries, including the UK and Canada, payment for order flow is not allowed at all. The US financial markets regulator, the Securities and Exchange Commissioner, now says it is investigating the practice. It is also investigating which apps are encouraging overtrading with email alerts, prompts, and other tools. Well, we can certainly say eToro is constantly sending us messages that the cryptocurrencies we are either trading or viewing are going up or down. So, encouraging us, therefore, whilst it's a useful service, potentially to buy or sell. But we've been at this for too long to be coaxed, encouraged, cajoled into activities we do not wish to undertake. So how do trading apps that offer free trading make money in the UK, where they cannot sell their order flow? In the case of free trade, it makes money by selling investors an upgrade from the free platform to a premium version with more features, says Mr. Dodds. People know what they're paying for. It's not like everything's free and then there are hidden fees in the spread, he says. But he argues that zero commission trading is important for democratizing investment, i.e. opening it up to smaller investors. And we would agree with that. 40 years ago, 50 years ago, only the moderately wealthy could invest. You really cannot invest £100 a month in 8 or 9 stocks when you pay £10 to £12 commission on each trade, he says. Meanwhile, Miss Ian and her boyfriend hope investing in stocks will help them move out from their small London flat and assemble a deposit for their first house. We kind of realise just living off our salaries will probably not get us very far, taking inflation into account as well, she says. And there are pros and cons here. The advantages are it does open up the equity markets to individuals with relatively smaller amounts to invest. The danger is over-investment or over-activity in their investment, causing people to buy or sell at a whim. Then comes, of course, the addiction habit, whereby you may find that your shares have gone down, and so you buy, and they go down, you buy, and you go down, you buy, until eventually you run out of money, and they continue to go down, and then you panic and sell, and you lose 90% of what you've invested. Equally, they go up and you buy, and they go up and you buy because of fear of missing out, and then you find that 90% of your purchases are at an all-time high, and then the markets crash, and you sell, and you lose again. But at the end of the day, we're all free individuals, able to do, to some degree, what we wish. And therefore, if we make those silly decisions, then we have to suffer the consequences. We are certainly in favour of trading apps. We do think people should educate themselves first before entering into these investments, and also read the terms and conditions that many of these platforms put forward. Are they regulated? Because there are so many scams out there, it's now very difficult to differentiate between those who are legit and those who are scamming us. But that's the brave new world in which we live. And this is also the world in which, unless gold and silver can offer something more digital online, or a more active participation within the digital marketplace, and we know there are some areas where this is being covered, then it may find itself lagging in terms of investment monies. And we have seen this over recent years with the flock to cryptocurrencies and equities. Your thoughts, please share. Also, if you haven't done so far, please take a look at our Crypto Plus channel, where we're about to launch some new videos in the next few days on the whole issue of cryptocurrency, blockchain, smart contracts, definance, and other investment platforms. Thank you so much for listening. Please give us a thumbs up, subscribe, press the bell sign, and comment. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management, and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice, and merely represent the personal views of its owners.